last week, everybody had been saying, we need this washout, we need this washout. And the market had become very oversold and very overhated going into Friday. Then Friday, we had the expiration and we had the rebalancing. And of course, algos exacerbated everything. There was some new news, but nothing really big out there. And it was kind of an artificial flush on the market. The same thing happened on Monday, where the market was very, very thin because of the holiday. And then, again, the algos kicked in. Oil went down. That was really the only news. There was no news out at 11 o'clock. The last 2 hours of trading, the market went down over 500 points. That was the flush. So I really expected a bounce on Wednesday. I didn't think it would be 1,000 points. But the one thing we got was yesterday is exactly what the bulls wanted. Because not only did the market, in other words, when the market gets washed out, it leaves nobody left to sell. And that's what happened on yesterday. The sellers tried one last gasp effort to knock the market down. They couldn't do it. They were done selling. The market rallied 900 points. I think they kind of confirmed that we did get the washout. That doesn't necessarily mean we've seen the bottom on a long-term basis, but I think it's going to settle things down and we'll see a nice rally as we move into the new year. Okay, I like the optimism here. Listen, I like to talk about oil and gas because it's what I know, but it really doesn't matter that much for the market. It's about 6.5% to 7% of the S&P 500. The banks and the financials do matter. We're going to dive more into them with a different guest in a few minutes, but I'll ask you this from a market's perspective. Do we need to see the financials rally for the whole market to go up? Can the market go up if the banks don't, in other words? It's very difficult for that to take place. I mean, the banks tend to lead. They start to head down first before the rest of the market. And again, we saw that this time, where the banks underperformed for quite some time before the market topped out in October. The one thing it looks very good because they're very cheap. Some are at book value, some are below book value. That's very good. But we also, I think, a lot of investors are afraid to jump in with both feet because if we're headed for any kind of recession, whether it be next year or the year after, the bank stocks, although they tend to bottom early, they don't bottom until we're well within a recession. We haven't even started a recession yet. So I don't think even though people like the fact that the group is cheap, they're not going to jump in with both feet for a while because of that reason. So I have to be a little bit careful. There's a lot of reasons to be bullish on the banks, but there has been a lot of reasons for the last year, and they haven't acted well at all. So if this group doesn't pick up, it's going to be tough to do anything. Down 640 on Monday, up whatever 1,100 it was on Wednesday. Down 500 plus yesterday. Then we came back to end the day higher. What is this all telling you about the market structure? Getting a lot of questions about this. People saying, even if I'm bullish on stocks, Brian, I just don't know if I trust the stock market anymore. It's very hard to blame them. And, a lot of people blame the algos. And usually when the consensus says one thing, I like to say the other. But in this case, they're right. These it's momentum-based algo trading just takes intraday moves to much more extremes than they have in the past. So we need the market to settle down. I don't know if we need any kind of regulation for this algorithmic trading, but it's something that's certainly hurt investor confidence. We already have enough uncertainty out there with whether it be Europe, the trade war, obviously the Fed, things like that. We don't need it more with the way the market is traded on a daily basis.